€8.8 billion in revenue, with gross margin hitting the 53% ceiling in the semiconductor industry. ASML Holding has never been just a company, it's more like a high-stakes bet on the physical limits of humanity, as memory giants aggressively place AI-driven orders. And next-generation lithography machines priced at $400 million begin commercialization. ASML delivers what looks like a nearly perfect earnings report, yet the stock drops sharply. So is this a classic sell then news reaction, or is the next phase of the race just getting started? Hey everyone, welcome back to Deep Dive Stock Earnings. If you want to understand the endgame of the AI era, ASML's earnings are basically the ultimate guide. The company just raised its full year 2026 outlook, showing very strong confidence, but the market's reaction cold, almost like it's not buying it. So here's the real question. If the fundamentals are this strong, why is the stock going down? Let's start with the most straightforward numbers. ASML reported €8.8 billion in net sales for Q1. with €2.8 billion in net income, but the real standout is the gross margin, 53%, right at the top of its guidance range. And this profit isn't just coming from selling machines. A big part of it comes from what they call installed base management, basically upgrades, maintenance, and ongoing service. In other words, this isn't a one-time sale. Once you buy their machine, you keep paying. It's like buying a high-end supercar. Real money isn't made at the sale. It's made through everything that comes after. That's why even during industry fluctuations, ASML can maintain such strong margins. Now let's look at a more important signal. While Q2 guidance looks relatively flat, ASML did something that really matters. It raised its full year 2026 revenue target from €39 billion to €40 billion. What that's really telling the market is simple. Demand in the second half is expected to be stronger. You can think about it this way: if a company is confident enough to raise full-year guidance, it usually means the orders are already locked in. What looks flat right now is probably just timing. The real growth is likely to show up later. There's another shift that really stands out. The share of revenue from memory customers jumped from 30% to 51%. This isn't a fluctuation, it's structural. And the reason is simple. AI isn't just about compute. It's fundamentally data-driven. Every training run, every inference call pulls massive amounts of data, and that data requires high bandwidth, low latency memory like HBM and advanced RAM. If bandwidth isn't there, if latency is too high, then the most powerful PAs can't perform. This is a critical signal. In the past, it was mostly Taiwan semiconductor manufacturing company driving equipment demand. Now Korean players like Samsung Electronics and SK Hynix are stepping in aggressively. That tells you the game has changed. It's no longer just about compute power. It's about the entire system. When memory crosses 50% of demand, it means AI infrastructure is now scaling across the full stack. From a geographic perspective, there's also a major shift. South Korea now accounts for 45% of revenue, becoming the top market. Meanwhile, China dropped from 36% to 19%. This isn't just quarterly noise. It reflects a redistribution of demand. Export restrictions are clearly impacting order flow, while advanced node expansion is shifting toward Korea. At its core, this is a map of where global compute power competition is heading. But from another angle, this actually reduces risk. ASML is no longer dependent on a single market. Instead, it's positioned right at the intersection of multiple global AI races. You can think of it this way: whoever is scaling capacity ends up paying ASML. The diversification makes the business more stable over time. Now let's talk about technology. A major milestone is happening with High-NA EUV systems, priced at over $400 million per unit. These machines have already processed more than 500,000 wafers in testing, with availability exceeding 80%. That means they've moved beyond validation and into real commercial viability. At the same time, they reduce process steps and simplify manufacturing complexity. This isn't just an upgrade, it's a step change in efficiency. Yeah, $400 million per machine sounds insane, but for top-tier fabs, it's a necessary investment, because what they get isn't just performance, it's higher yield, lower complexity, and better economics. If you want to enter to nanometers or beyond, there's basically no alternative. This ASML's real mode is not just better, it's essential. At the same time, efficiency is improving with higher power light sources. Throughput per machine has increased from 220 wafers per hour to 330. That's close to a 50% jump. At incremental but transformative for unit economics. That extra 100 wafers per hour matters more than people think. At scale, that translates into hundreds of millions in additional annual profit for customers. So what ASML is really selling isn't just equipment, it's the ability to generate more profit. While others are still figuring out if something can be built, ASML is optimizing how fast and how profitably it can run. Finally, let's address a commonly misunderstood number: cash flow. Free cash flow came in at negative €2.06 billion this quarter. That looks alarming, but it's really a timing mismatch. These machines take a long time to build, and there's a gap between order intake, prepayments, and production spending. For a company like ASML, this kind of fluctuation is normal. You can't evaluate ASML's cash flow like a typical company. This is heavy industrial equipment with multi-year delivery cycles. Short-term negative cash flow often means they're ramping up production for future orders. In other words, it's more about preparing for growth than signaling weakness. Even with near-perfect earnings, the stock still dropped. The reason is pretty straightforward. The market had already priced in most of the good news. As machine prices rise toward $400 million, the industry itself is becoming more polarized. Only the top-tier players can afford to keep investing at this level, which means competition is becoming more concentrated. So here's the core question. This isn't about fundamentals breaking down, it's about a mismatch between expectations and reality. The tech is getting stronger, the position more secure, but the market is reevaluating future returns. So is it worth this price? I'm Deep Dive Stock Earnings. See you next time.